Welcome to Markets Now. I'm Michelle Ruck along with Darin Newsom, Senior Market Analyst with Barchart. We are seeing higher prices in everything but hogs today, and grains leading the charge, Darin. And we're in a full-blown weather market, and I guess everybody's probably asking, how high do you think we're going to go here?
Yeah, that is the question of the day. After Thursday's close, my target was up there around 580 for Dees corn, and it didn't waste any time blowing through that Thursday night through Friday morning. So now, that opens the door. You got to imagine there's a lot of sell orders ready to go at 595 to 6. Corn likes round numbers. So we may bounce around up there for a little while, but again, we've got time with this weather market. If they usually last about 6 weeks, that means we've got through the end of June. So there's time for this market to get through the $6 level. Once that happens, it'll be, at that point, it becomes how many are still willing to buy. And it's really hard to put a top in at that point.
Is this a typical weather market? It seems like it might be for corn, maybe a little early for beans or not.
Yeah, I think it's a great question. I think it's a little early for both, but certainly too early for soybeans. There's really nothing threatening in the soybean market right now. So I think it's kind of riding the coattails of basically the old crop market. And that's where it's really been interesting, is watching the July and August contracts. August, I can't believe I'm talking about August soybeans, but July and August is really where the story's been. And given the fact that we aren't exporting anything, this puts the spotlight on crush, domestic crush, possibly even increased exports of soybean meal. So I think that's where the story is going to be the last quarter of the old crop marketing year.
Yeah, and we got that confirmed in the notebook crush report yesterday. It looked like there was some record crush.
Yeah, not surprising. Again, if we watch those, oilseed markets, we've seen some support building in bean meal and in bean oil. We also know, Argentina had a dismal crop this year, and it's what I like to call is a silly season for soybeans. This last quarter of the year, you got rolling from July to August, September, and possibly November. So it's hard to get a good read on future spreads and basis. But if we just look at the cash market, since the end of May, it's up like $1.20, $1.30 at least, just the cash index. So, there's a great deal of buying coming into the cash market. And that tells me that there is some demand for what we have left of old crop soybeans.
Well, that's a good thing because demand is not as good for corn. That's for sure from an export perspective anyways. Is it possible that because the funds were actually short corn and maybe only slightly long beans that they got caught flat-footed here ahead of this weather rally and they're pushing it harder?
I think so. I think in the corn market, they were short the old crop market. Again, we just didn't have any demand. We saw non-commercials build up a pretty sizable net short futures, but the last few weeks they have been covering it, to go along with the weather market going on in new crop. So you have the September contract then caught in between the two. So yeah, I do think some short covering has been the key in corn, soybeans. I think they've just been adding to their longs for the most part. But demand is an issue. And I mean, demand is a problem right now in the corn market. We're seeing basis really start to collapse, particularly with the futures market rallying. I'm hearing it for different parts of the U.S. Midwest and Plains right now. Basis is just kind of taking a beating. If there's some bushels coming out of on-farm storage, it's finding its way to markets finally. And if not, it just means that there's really no push there's no new demand coming in at this point from, feed or exports or ethanol or anything at this time.
Okay. So is there an analog year to compare this to from a drought perspective? Because, we always start going to 2012 and 1988, but those happened a little bit later in the season.
Yeah, I'm just not a big believer in analogous years. Chaos theory tells me if there's one difference in the years, and there's always one difference, you're going to have a different result. So I haven't really been looking back through the archives to see if there is an analogous year. I think we have to take this one on its own. We're coming off a 3-year drought. It was supposed to, we were seeing a shift from La Nina to El Nino. And we could still see that later this summer, where we could see more moisture across the Midwest. It just hasn't arrived yet. So that's why we have an early weather market. Have we seen weather markets in June before? I'm sure we have. I can't recall a year at this point, but I'm sure we've seen a weather market in June, particularly in corn. So I don't think it's anything extraordinary. It is unusual, but I think we'll see how long this plays out.
No doubt. And is corn and soybeans to rally there just pulling wheat along, or are we blown out of those shorts, especially in Chicago? I mean, that was a pretty massive short position they had.
Yeah, yes, all the way around. I think some of the reason why we're seeing this massive short covering going on in the Chicago and that net short futures position as of the last report last Friday was almost 91,000 contracts. It was just enormous for Chicago wheat, and so we've seen a great deal of short covering coming into that market. Again, you've got a rally going on in corn, soybeans. They don't want to be sitting out there holding short Chicago because it's probably going to rally at some point. We also have to calculate. We've got harvest going on, and if these funds are short and they want to stay short, they're going to have to move from the July contract out to something else anyway. But it's a different situation in Kansas City. Kansas City's been talked about. The Kansas City hard red winter market's been talked about a great deal. Due to the drought across the southern plains, how much of the crop was supposedly dead. The reason why we really haven't seen Kansas City move, particularly in relation to Chicago, I just think that there's still this thought process that the wheat crop has to prove that it's dead. They know that there's going to be a soft red winter crop, but so much of the hard red winter crop was expected to just be zeroed out. So now it has to be proven. Once the combines start rolling through the worst of the southern plains, if there's actually very little wheat there, then I think maybe the Kansas City market starts to react, possibly starts gaining on Chicago again.
Okay, yeah, because they've unwound that spread, haven't they?
Mm-hmm. Yeah, they really have. That's been dramatic over the last couple of weeks. And as you said, a lot of it has to do with the short covering in Chicago. They've been holding a relatively flat position in Kansas City. I do think it'll build to a long. We still have more bullish fundamentals in the Kansas City market. If we look at future spreads, they're still inverted. So, if funds want to follow that rather than just the more heavily traded market in Chicago, then I think it could bring some buyers back into Kansas City over time.
Gotcha. So we're up in the cattle market here today, and I think there's a lot of agreement. Maybe we put in a short-term top anyways, but longer term, are you bullish? Do you think we go back up and challenge the highs at some point in time?
I tell you, this market has proven, one of my rules talks about if a market that can't go down won't go down. And this certainly has been cattle for the last 6 months to a year. I mean, it's just been an incredible market. So many times we do see some technical tops forming and then they just get blown out. I do think this market's getting a bit top heavy, but as long as boxed beef continues to go up, as long as they're willing to continue to push the cash market higher, then it's going to be very difficult to break this market. And so we may see a few days down, we may see a couple weeks down. But by and large, I think you're going to find plenty of buying until, the cash side actually proves that it's done rallying.
Yeah, we did see some lower cash trade this week. I think $4 lower yesterday in the dress market. We haven't had a lot of trade in the North and the South I've yet to see. So even with cash being a little bit lower, the futures are at such a discount. It really doesn't matter, does it?
No, I mean, that's a strong basis. So the way we've seen the cash market rally and cash over futures is really, it's still considered bullish. So if you see the cash market back off a little bit, I don't know that it'll immediately bring pressure into the futures market. It certainly could, because again, we've had funds doing a lot of buying in here in the cattle market. And if they start to sense a little bit, sharks in the water, if they start to sense some blood, some cash markets starting to weaken a little bit, they could start getting out of those and really, like we've seen in so many different commodity markets, commodity sectors, just, switch over to something else. Maybe it's time to move from livestock back over to grain and oil seeds.
No doubt. Choice boxes, though, clearing the 342 mark. These are levels we haven't seen for a while. Boy, you can't really say that demand is not good with that number.
Now, in my mind, I mean, that just continues to speak to just how strong consumer demand is for beef. Doesn't really matter the price. You got choice running away from select. You've got the market as a whole at prices we haven't seen since the fall of 2021. So almost 2 years down the road. It's an incredible market right now. And again, I use it as an economic indicator, general economic indicator for the U.S. And right now, it certainly looks bullish. And again, until we get some consistent breaks in this market, I don't think anyone's going to worry about it too much.
Yeah. And hogs have had quite a recovery off the contract lows. Was a lot of that just short covering, or here again, were we unwinding those cattle hog spreads, or was it fundamental?
Yeah, all of the above. Because what's interesting is we have seen the non-commercial side start to reduce its short. And again, this was another market where funds were not afraid to be short. But at the end of May, the CME cash index on its monthly chart completed a bullish reversal pattern. And this told us the long-term trend had at least bottomed out and possibly turned higher again. And this seemed to be bringing some buyers back in. Certainly has been providing some support here over the course of June, at least so far.
Okay. Thanks for joining us, Darin Newsom with Barchart, and that's Markets Now.